This example problem is about deferred tax assets. If we read the problem, it says ABC Inc. computed a pre-tax financial loss of $15,000 for the first year of its operations, ending in December 31st, 2011. Analysis of the tax and the book basis of its liabilities disclosed $55,000 in unearned rent revenue on the books that had been recognized as taxable income in 2011 when the cash was received. Also disclosed was $20,000 in warranties payable that had been recognized as expense on the books in 2011 when product sales were made, but that are not deductible on the tax return until paid. These temporary differences are expected to reverse in the following pattern. So you have these numbers, and we'll come back to these in a minute. Then you have the enacted tax rates for this year, and the next 4 years are as follows, and these are those numbers. And the instructions for the problem are to prepare the journal entries to record taxable income taxes payable and deferred income taxes. Assume there will be sufficient income in each future year to realize any deductible amount. Then prepare the income statement for ABC, beginning with loss from continuing operations before income taxes for the year ended December 31st, 2011. So to prepare the first entry, we'll have income tax expense and income taxes payable for $22,800. And the way we get this number, so for 2011, ABC has a pre-tax loss of $15,000. But ABC also has $55,000 of unearned rent revenue that they have received cash for, so taxes have to be paid on that in this year, which is 2011. And ABC has $20,000 of warranties payable that have to be added back into taxable income for 2011 because they aren't deductible until they are paid. So you have the negative $15,000 for the pre-tax loss. You add $55,000 and you add $20,000, that gives you $60,000. Times that by the tax rate of 38%, and that gives you income tax expense of $22,800. So that's how you get this number right here. Then, if you look at this entry right here, you have a deferred tax asset current and a deferred tax asset non-current, and the income tax benefit for $24,240. So the way we get these numbers, okay, so if you use the table, and we will go to this table right here. So if you look at these are the deferred tax assets set up for each year basically, and then this is the percentage of this number. So I guess the table's set up weird. But anyways, so if you look at this table, in 2012, of the $24,240, you would classify for the current portion, it would be whatever the asset valuation is in 2012, because that's from right now, that's what we will cover within the next year. So that's the current portion. So 6,480. So that's how you get this number right here, and then this is just the balance of that, and this is the total amount. So the amount debited to deferred tax asset current is 6,480. The remaining amount, 17,760, is debited to deferred tax asset non-current. The total amount is credited to income tax benefit, and that account is offsetting the income tax expense account. You can put down income tax expense and you'd be crediting an expense account, or you can just use income tax benefit. So that's how you do that. And then number 2, prepare the income statement for ABC beginning with loss from continuing operations before income taxes for the year. That's this right here. So ABC partial income statement for the year ended December 31st, 2011. You have the loss from continuing operations before income taxes of $15,000. Then you have income taxes on continuing operations. You have the current provision, you put the current year's income tax expense here, $22,800. Then the deferred tax benefit below it, $24,240. The difference is a positive $1,440. You offset this against the loss from continuing operations. So your net loss for the year is $13,560. And that is how you do that problem.